Moving countries can be one of the most exciting and most challenging things you'll ever do. And we're here to take one big worry off your plate: your taxes. At Expat Taxes, we understand the complexities of Irish tax from your perspective as an expat and tailor our advice to your needs. With decades of expertise, our team at Expat Taxes will help you navigate tax residency, cross-border taxation, reliefs and returns, and will work with your country's tax advisor to make sure your taxes are sorted. Whether you're an individual or a corporation coming from Australia, the United States, the UK, or anywhere in the world, we want to help you. So visit us at expattaxes.ie to book a consultation today, and let's make moving to Ireland easier together.
Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Welcome back, everyone. This is part 2 of my interview with Marc Westlake, where we'll talk about maximising your pension, diversification, and being money savvy in Ireland generally. If you missed part 1, please go back and listen to hear about Marc's background. And thanks for subscribing to the podcast. Now, let's get on with it and jump right in. Let's go back a little bit, because I'm conscious that some of the people listening to this may or may not know anything about pensions.
Okay.
Tell me, if you talk to a client, what you say to them if they say, tell me about pensions in Ireland. A generic phrase like that, a question like that.
Yeah. Okay. So that's a really good question. So if you think about the way retirement provision is designed to work, and this is true pretty much the world over, you've got a basic level of subsistence protection through the form of Social Security. You see it in the US with Social Security payments, you see it in the UK with national insurance, and you see it in Ireland with PRSI. And that's essentially a safety net. People describe it as a benefit. Some people don't describe it as a benefit. There's some discussion about whether you're entitled to these things or whether you have to claim them. But broadly speaking, we set aside money, and we have done since Beveridge created the state pension in the UK in 1948. We put money aside for our old age with a basic state pension. It's £11,000 a year in the UK. It's 12,000 a year. It's 13,000 a year in Ireland. It's not enough to live on, but it's enough to keep the wolf from the door, and it gives you a basic subsistence level. What I find really interesting about that is, and the UK Ireland is a classic example, if you look back over the last 30, 40, 50, 60 years in Ireland, how many Irish people have spent some time working in the UK and then come back again, and vice versa? Many people, and I'm going to go as much as, probably half the people I've met in the time I've been here, know somebody. It takes it up to 75% of the population now who knows somebody who's worked in the UK. You can top up your UK state pension by paying voluntary contributions from Ireland, in addition to your PRSI, to top up your Irish state pension. And under current rules, which could change, but under current rules, you're entitled to claim both. So I am 1 year short of a full UK state pension. That's how old I am. I've been paying my voluntary contributions, £160 a year since 2008. I've bought back all the missing years, and you can do that all the way back to 2005 still. There's a window at the moment which is closing very soon. Get your skates on this one. But that's an extra £10,000, £11,000 a year of guaranteed state income that you can get from topping up your UK state pension. If you walked into Irish Life and said, I'm going to give you a cheque, give me £10,000 a year, how much would I need to give you? It's about £400,000 a year. So that's what that's worth to you. And then in addition to that, under the current rules, and they're just about to change in 2025, but under the current rules, if you rock up in Ireland age 56 and work for 10 years, you'll have paid into the Irish Social Security system for 10 years, which is enough to get your full £13,000 a year Irish state pension, in addition to your UK £10,000 pension, and you're entitled to claim both of them under current rules. So before we get out of bed, that's where we start, because those are absolutely cast iron, easy to understand, guaranteed benefits that everybody's entitled to and everybody's entitled to claim. I fear that having promoted this as a concept for the last few years in Ireland, we're pretty much on the basis now we're probably going to bankrupt the British government because everyone I know is taken into the cleaners. But look, them's the rules, right? So I'm not going to say anything, but I think I'm personally responsible for the British government deficit at the moment. So that's the first pillar. And then the second pillar then is most of us have either an occupational pension at work. And the first thing I would say is if you're moving to Ireland from another jurisdiction before you sign your employment contract, ask the question, is there any possibility of putting a discretionary bonus directly into a pension rather than putting my pay through payroll, paying tax on it, and then me making personal contributions? And the reason why that makes sense is that an employer's contribution to your pension in Ireland is completely uncapped. If you have a salary of 250,000 a year and a 100,000 a year bonus, as Stephanie said, you're going to pay 52% margin rate of tax on it. If you just take the 250 salary and put the 100 grand bonus directly straight into your pension, the employer will save tax at 11% on the payroll and you'll save 52% tax on it. So it is the most tax efficient thing you can do. And it's too late. If you've already signed the contract and you come to me and say, I'd like to do that, we'll say that salary sacrifice, you're changing your employment contract, you won't be allowed to do it, it won't work. It needs to be before you sign the contract.
That's such a useful point. My simple mind thinks of pensions like this, and this is the way I explain it to my clients. You pay a high rate of tax in Ireland as an employee. So put as much as you can into your pension because your pension grows tax-free. And then when you get to retirement age, when your income has naturally fallen and you therefore are in a lower tax bracket, you can also take income from that pension as well as a lovely little tax-free lump sum. And, oftentimes it's back to your point around, how do you want to spend your money, but equally potentially accelerating the point at which you can go, you know what, I'm done. I'm leaving employment because I've put enough money. So it's smoothing, isn't it? Sacrifice now for benefit later, assuming the market performs. And that is a caveat, of course.
Well, it's also, there's a common kind of perception that a pension is for your old age and that you get it when you're in your 60s and 70s. And when you're in your 20s, that puts you off saving. Because you think, well, I'm not in my 60s and 70s, so I can do it later, right? So then you get into your 30s, you have a family and a mortgage, and you can't really afford to save. So then you get into your 50s, and you're really struggling to play catch up, right? So the first rule of thumb with retirement planning is start early. The UK changed the rules a few years back, and I remember distinctly when the rules changed, and it said anybody under the age of 75 can put money into a pension and get tax relief at source, even if you've no earned income. You get 2,808 goes up to 3,600. Remember the number, 792 in tax relief. It's a 28% guaranteed return on your contribution day one. And I read the legislation, I kept reading it. It kept saying anybody under the age of 75. So what we started doing was setting up children's pensions for newborns because it didn't say you weren't allowed to. So the grandparents were putting 3,000 a year into a pension for the child who's just been born, and the money was compounding up for 40 or 50 years. So there are precocious little Jemimas walking around in the UK now with university degrees that have been paid for by the pension funds because I set these things up in the early noughties. Now, the concept there is start early. Now, I turned 53 years ago, and what did I do? I cracked open my pensions because I'm allowed to. I took out a tax-free lump sum and I paid my mortgage off. And everybody says, what do you do that for? Surely you should be leaving the money in the pension to grow. I said, well, the mortgage rates were going up and I have a large mortgage and I have two kids, one in private school, and it's struggling financially. So do you know what I did? I made my life easier. And do you know what it did? It freed up the mortgage payments to go into pension contributions, which I get tax relief on. So recycling the same money and getting more out.
And I think, I loved corporate finance. I have a master's in accounting. I loved it, but I haven't looked at it for many years. I'm kind of reluctant to say how many. But the point being this, sometimes I think all of this sounds like double Dutch to people who don't do this. And I love to say to people, this is, don't get shrouded in darkness with jargon. This is simple. Now, of course, in my mind, I go, right, well, so you've got compounding with a pension, potentially you've got X amount now is worth X amount in, more in so many years to come. You've got to weigh up the repayment of the mortgage against the potential interest or income that you would earn in the pension. But ultimately, your point there is, well, it's a simple mathematical thing. If I'm willing to, what suits me now? And of course, you might be foregoing some increased income in future, but that's not of value to you at that point. So that's very smart. It's a very sensible way to approach it.
Exactly. And I mean, you say we can make it more complicated. I mean, if you actually look at what I actually did, I transferred my UK pension benefits to Ireland, where I left them for 10 years. The HMRC reporting drops away after 10 years and the UK loses interest in it and it becomes just a pot of money. And then I said, right, fine, what I'll do then is I'll move that out of Ireland. So I moved that to another EU jurisdiction. Actually, my pension is now sat on a deck chair on a beach in Malta. And what that enables me to do is I've now a source of offshore income. And I am Irish resident and non-domiciled because my father's not Irish. And therefore, I'm entitled to a source of tax-free income. So I took money that was tax relieved in the UK, getting highest margin rate of 40% tax relief on the contributions. The money grew tax-free from 20, 30, 40 to 50. At 50, I threw it across to Malta, took my lump sum, paid my mortgage off in Ireland. I've now got my holidays paid for, tax-free, because I've got an offshore source of income that I wouldn't have otherwise had. So I'm doubling down on that planning.
Does Everlake do much pension transfer work for clients?
Yes, yeah, we do a lot. Yeah, so the really interesting, and again, I'll speak in the first person because I've done it. The rules keep tightening up as you look around the world on what's acceptable practice and where revenue take a dim view. So the UK QROPS rules, since 2017 have got a lot tighter. You need to be out of the UK for 10 years and your pension needs to be out for more than 5 years for the HMRC to lose interest on it. That's a bit tricky if you're in your 50s because you probably want the money before that. So these are considerations, and we always ask the question: should you make the transfer? And if you should make the transfer, when should you make the transfer? So let me give you a classic example. Everybody knows that a defined benefit pension, the gold-plated old-style pensions that almost nobody has any anymore. Nobody has them anymore. They're so valuable that they used to bankrupt companies. There was a joke in the City of London a few years back that British Airways was a pension company that just flew airplanes as a hobby because they had a billion pound hole in their pension fund. So they were very focused on fixing that. Boots a few years ago took all the money out of the stock market, just put it in bonds because they said this liability just is getting bigger and bigger and bigger. We want to just cap it. So these things were basically destroying companies. They were so good, right? So everybody knows you touch that, it'd be bonkers. We just recently did a bit of planning for a lady. She was retiring from IBM. And she was offered the pension. It was a fairly decent pension, 40 or 50 grand a year, and a tax-free lump sum of 127,000, which was 1.5 times final remuneration, which was the maximum she could have under those rules. And she said, I'm just going to go for this, aren't I? And I said, well, again, like you said, it's just a bit of maths. Most financial planning is just basic arithmetic. Is there another way you could do this? You're going to get a better outcome. And sure enough, there was a 2.2 million transfer value that we could took over. She has a 71% tax because she's gone over the 2 million lifetime allowance. We took our fee from that. So revenue subsidized our fee. Thank you, revenue. Subsidized our fee to the rate of 71% tax relief, which would have been money she'd have paid away and lost. And we took the transfer value out of the defined benefit pension, gave her a lump sum of 500,000, of which 460,000 was tax-free, and gave her a pension of 80,000 a year, right, guaranteed for life, because she didn't need a widow's pension for her husband, because he also had a very good pension of his own. So a little bit of planning that was very, very focused on the client's circumstances led to a massively incremental benefit to her relative to the guarantee pension that was on the table, because the guarantee pension and the rules were very, very set in stone and not flexible. So you have the option to take what's given to you, or the option to look at whether maybe a bit of planning might make sense. In her sense, it did.
So I suppose my question there would be, is there a requirement to demonstrate bona fides there from the point of view of transferring it offshore for somebody who's staying in Ireland?
So that's a really interesting question. So revenue looked at this in the High Court in the O'Sullivan case, O'Sullivan versus Canada Life a few years ago. And we all know about the free movement of people around the EU from Brexit, right? I've still got a British passport. It doesn't work very well anymore. So we know about that, but there's 4 pillars of the EU, and one is the free movement of capital, right? So I am free to move my euros to a German bank. I've got money with N26 in Germany. I am free to move my Irish occupational pension to another European jurisdiction under the IOPS directions, which is the pension regulations. I am free to do that. But bona fides are, it's my money and I'm entitled to do it. Now, revenue can say you're not entitled to do it for tax evasion reasons. And my argument would be, well, I'm not doing it for tax evasion reasons. I'm doing it for diversification reasons, financial planning and retirement planning reasons. There's likely to be an election in the near future. We've seen, how should I say this delicately, populist governments in the UK and the US come in. Ireland's likely to get a populist government with a magic money tree outside Leinster House, promising all moon and the stick. I'd have some concerns about the finances of the country. It's not inappropriate to put an argument that says, I'd like to diversify some of my wealth into another European country, given that A, I'm allowed to, and B, it's very prudent to do so. That's bona fide as far as I'm concerned. And I'd be happy to argue that in court.
Oh yeah, and I think the thing is as well is that it's like anything with a transaction. Many transactions have different components. Tax is usually one consideration, and that's exactly what we've been saying the whole way through. Is that whenever you're mounting an argument, there's a commercial transaction or a transaction being affected for a reason. It's not possible to say in most cases that something's purely being done for tax reasons. Of course, revenue may argue differently, but that's the point, isn't it? Is that I just had a call earlier with a founding partner of a new UK company that is creating an application to Dacium for anybody who wants to look them up, which will monitor the movements of people and create a very robust log of where people have been. And it's really down to this concept, which is, it's not what you know, it's what you can prove. And that's a comment that comes up in appeal cases. And, I know barristers quote it when they're recommending how practitioners approach these slightly unusual situations. Because what you're describing, Irish people, and I don't want to sound kind of like as if I'm stereotyping, I feel as if in recent years, Irish people have become more financially savvy.
Oh, totally. Absolutely.
That's a result of the fact of easier access to information, arguably more money in the country, ability to trade on platforms. I mean, I have shares on my phone in my Revolut account that, I would never previously have been somebody who'd taken interest in something like that. We've all but become more sophisticated, I think, in terms of accessing information and accessing the ability to do this. For you, that probably means that people realize they need to be more educated and ask questions when they're in this niche category of not being just a standard investor.
Yeah, I think you need to disaggregate that more sophisticated part into two sections. The world has become more sophisticated, more complex, more global, more intertwined. Artificial intelligence has come along. There's been the availability. You used to have a stockbroker. You used to go and meet a guy with a top hat on the Strand in Coots in a black frock coat, and he was your stockbroker because you banked with Coots, and you banked with Coots because the Queen banked with Coots. I have met people like that, and they talk like this. The reason they talk like this is so you can't get a word into it, and that is how the world has always been. And now everyone can have a stockbroking account on their Everlake card. And suddenly that makes us more sophisticated. No, that doesn't make us more sophisticated. That makes the solution and our access to capital markets easier. But that doesn't mean that we've carried up the knowledge and experience and wisdom that we need to be able to understand how this stuff works.
That's brilliant. Yeah, I really agree with that. That's so true. Yeah, you've paraphrased what I said very well. Actually, I didn't say that. You said it much better.
Yeah, so we've opened the door to the sweet shop and we put the 7-year-olds, and guess what? They're stuffing themselves full of sugary sweets. And we're saying, what are you doing? There's a fruit and veg shop next door. You open the door to the sweet shop and we're going in and we're gonna go and buy Bitcoin, whatever that is, and speculate with meme stocks and things that we don't really know what we're doing, but everyone else is doing it. And the guy on TikTok sounded very plausible.
Let me ask you a question, just even for a laugh. Do you have any NFTs?
So I think there must be at least a generation between us. No, I don't. No, I mean, my 14-year-old son calls me a boomer, and he enjoys doing it because he loves taunting me, because he's already more aware of that digital world than I ever will be. I mean, the joke I've always said, and I can't believe I actually now do it in my house, is if an electrical item stops working, go and find a 14-year-old to fix it for you. So that generation that's now being brought up with AI and, access to the internet and all of this, disintermediation of the old world and the rise of whatever comes along is going to make the world a smaller place, a more integrated place. Some of the saddest things that I've seen recently is Elon Musk taking over Twitter, for example, which was a free resource of debate and dialogue, and it's been, I don't know what it's turned into. It's turned into a skip fire of whatever he's made into it. Some of these things are a force for good, and some of them are a terrible, terrible power, which is just unleashed on an unready and uneducated or less wise audience. I mean, you see bubbles and manias throughout history. Tulip bulbs in Amsterdam and all of these things. History just keeps repeating and repeating and repeating. And things like Bitcoin and NFTs and meme stocks were all examples of this. Just a new version of the same old story, and you need to have that historical perspective that goes right back over hundreds of years before you're able to say, we've seen this before, we know how it plays out, we know how it's going to end. You should not be doing these things because they're popular and available at the time. There's an availability heuristic. Things that are put in front of us opportunistically become bright and shiny and flashy, and we want to be interested in them. And it's not, that's not investing. I don't know what is gambling. It's probably the best example of what people are doing there. So,
and it works for some people until it doesn't. You could spend an hour talking about that alone. Okay, look, we've covered a lot. I'm conscious, we're coming up on time, and I kind of feel like we could probably definitely have another chat. What would you like listeners to take from this episode if they had to kind of distill 3 key points from what we've discussed?
Oh, that's a great question. So, I mean, we've talked about this before. I mean, having moved from the UK to Ireland myself, if I could tell my, late 30s self who's just met my now wife skiing in France and decided to sell a house and move to Ireland, if I could do 2 or 3 things in preparation of making that move that would have made my life much more comfortable and easier, I would have definitely listened to that. So, the mistake that we see time and time again is people will ring up and say, now I've moved my family over from the US or the UK or Australia to Ireland 2 years ago. And, I've settled in now and I'm ready to get some financial planning advice. And there's a joke in Ireland, this whole joke about how to get to Limerick. And the punchline is you wouldn't want to start from here, right? The place you should have started from was 3 years ago or 4 years ago when you were thinking about moving from where you were to Ireland. Pick up the phone, get in touch with Steph, get in touch with me and say, I need some financial planning advice. I'm moving from this jurisdiction to this jurisdiction. That is a life-changing event. I probably need some help and guidance from somebody who's done it or is aware of what the issues and the pitfalls are. Can you give me a step plan about what I need to focus on, where I am, what I need to focus on, where I'm going to, and what are the avoidable traps that everybody makes? And I'll give you a classic example from the UK. I mean, in the UK, individual savings accounts are very popular. They're tax-free. You can put, £10,000 a year. A husband and wife who put the money in every year. It's fantastic. They've been around since Nigel Lawson did the first personal equity plan in 1986. I remember because it took one out, right? They were really, really, really popular. They've been really, really fantastic. And they're tax-free in the UK. And people come over and they say, I've still got my ISA in the UK. I said, well, did you not think to cash it in? It's a tax-free plan in the UK. I said, well, it's tax-free. And I said, no, it's tax-free in the UK. You don't live in the UK. It's not tax-free here. You've just created a massive tax bill for yourself. And they said, well, I've only been here sort of 2 years. I said, no, the tax bill is for when you bought the investment, not when you moved to Ireland. And they say, well, that doesn't sound fair. I was like, when was fairness and tax ever a consideration? Or logic and tax? So, that's an absolutely classic schoolboy error that everybody makes. And it's just so avoidable.
And to be honest, this time of the year, it's December, and we're always in a rush to help clients kind of just to tidy these things up before the end of the year because, my line to clients is, you want to have it right by the stroke of midnight on New Year's Eve. And if you do, you're happy for the, you know what I mean? So there is ways to deal with this, but you're right. I hate those calls. I hate been here 2 years and you think, oh no, what's the news we're going to have to deliver?
Yeah, it's never good news. So, and the second thing would be, don't focus on more money being the result. Right? Think of more life being the result. So the finite resource that we all have is not money, it's time. Okay. So, your focus, I think, should be on what is important about money to you. So the question we always ask is, what's important about money to you? And people say, financial independence or some kind of, something like that. And I'll say, well, what's important about that? And they'll stop and they'll think, I thought that was it. I thought I didn't need to go any further. And then they'll sort of, typically most of us will reflect on something from our past. It was like, what was money like growing up? And I grew up in the 80s, you didn't have a lot of money. Christmas wasn't a great time of year, and what drives us as individuals is what our learned experiences were, our habits about money are learned from sitting on our granny's knee and what was money like growing up. So I'll ridiculously spoil my children at Christmas. And you think, well, why are you doing that? Because I never had it and I want a better life for my kids. So you say, well, okay, so that's what's motivating you. So, have you got a will? Oh, no, I don't make a will. It's like, so your children are important to you, but you think you can live forever? So it's just trying to join up those pieces of what we say people's values about money are more important than how much they've got. I can work with a set of values. I can't work with a bank account.
I think what you're saying there is the measurement of success in financial planning should be happiness, not bank balances. That's it. And that sounds, to be honest, sounds a bit cheesy, doesn't it? Because you're kind of like, people think, well, I need a life coach. You're like, no, you need a financial planner who actually helps you achieve what it is with the remaining time you have on this planet. That's it.
Yeah, you're right. I mean, when people ask me at a party what I do for a living, I now just say I'm a financial psychiatrist.
I need a session with you.
Lie on the couch. Tell me about your relationship with money. Did you say mummy? No, money. I thought you were Dr. Freud.
Dr. Mark Spock.
So yeah, it is exactly that. It is exactly the happiness. And like I said, financial planning is making good decisions about your lifestyle, how you live, the way in which you live. Is your lifestyle sustainable? And sustainable could mean sustainable in a sustainable investment sense and social responsible investing, or it could mean, is it sustainable for the whole of the rest of both your lives if you're married? and those are really difficult things to measure. And, most of us don't have a sense of how you go about that. And that's what good financial planning does. Good financial planning is it's part of its investment, but most of it is actually setting a destination that makes sense and then working towards it. And, as we're talking about this, it's not having your assets unjustly taken into, estate taxes or bankruptcy or, some predictably avoidable event like death, so things like life insurance. And it's about having some kind of advanced plan around efficiency, and things like taxes in Ireland are really a drag on, making that money go further. So a bit of tax planning, a bit of estate planning, a bit of investment planning, a bit of financial planning, put it all together. And I mean, that's ultimately what people should be doing. And it's not difficult, but again, it's back to my point, the Warren Buffett quote. It's like, it's simple principles, but it's not easy to do. It's not easy to do.
No, it's not. And I think sometimes having that somebody from the outside helping ask those hard questions. I mean, you don't really sit down on a Tuesday afternoon and ask yourself that, do you? You know what I mean? You kind of need that external question.
You do. The one thing that we bring to our clients is that objectivity. It's what I call the 2:00 in the morning second bottle of wine question, where if you're in a couple, you sit down and you've had a good evening and you're sitting down, and I say, get out 2 bits of paper and both write down the 6 most important things in your life, right? Then cross off 3, see what you're left with, and compare your notes. And where the crossover is, that's what's important to you. That's what's important to you as a family. That's what's important to you as a couple. Those are your priorities. And then look at your finances against that. And there'll be gaps. And that's your financial plan.
I think the third is, contact Marc for more help.
Yeah, I think you've made the point about education. I think that the line I always use is, knowledge is knowing that a tomato is a fruit, and wisdom is knowing not to put it in a fruit salad. You can get so far with Google. My doctor has a note on a cup in the office there saying, "Don't confuse your Google search with my medical degree." It gets you so far, right? But you do need that wisdom. You do need that objectivity. You do need that. This is a path well trod. We've been here before. Everybody says we're all different. We're not. We're human. We have basic needs. Maslow's hierarchy of needs for sort of shelter, self-actualization comes at the top. But warmth, shelter, basic needs need to be boxed off to feel comfortable and relaxed. And then we can start focusing on the big picture stuff. So yeah, I think educate yourself, listen to podcasts, do all that stuff, definitely. But yeah, hire professionals when you need to hire professionals. Don't try and DIY, and do not try and be a DIY investor in Ireland. You will fall on your face. I mean, I've been doing almost nothing else since I arrived in Ireland in 2008. I've had, articles published in the newspaper. Apparently I was instrumental in a revenue e-brief coming out around the taxation of offshore investment funds. I find this difficult. I struggle to keep up to date with all the complexity. There isn't a cat and house chance, and it doesn't matter what background you come from. A lot of our clients are, they work for Goldman Sachs, they work for the banks, they work for insurance companies. A client of ours is an actuary, a client of ours is a CEO of an insurance company. We've got clients working for BlackRock, we've got lawyers, we've got accountants, we've got tax consultants. It's difficult. You cannot do it justice. You won't be doing yourself or your family a favor if you try and make this up as you go along, because it's too hard. So seek timely professional advice. Definitely.
I think it's that phrase like penny wise, pound foolish. Sometimes people balk at fees, and we often say we don't sell time, we sell expertise. There's a difference. Anyone can give you their time, but expertise is something different. And it's the same with your area. I've really enjoyed talking to you. Thank you so much.
Yeah, likewise.
And I think we've touched on a lot of topics, and we'll have to organise another one. With a lot of people we talk to, we say that. We need to do it again. But I think, a lot of people, particularly those coming from the US, the UK, you mentioned ISAs. We always want to talk to clients from the US who often have kind of nasty investments lurking in their portfolios that they want to look at before they come to Ireland. And South Africa, there's often unusual trust-based arrangements that can cause problems. So your clients, I think, are going to find some of the topics we touched on today interesting in any event. So
no, absolutely. I mean, look, there's a whole bunch of stuff we didn't touch on. US estate taxes, all of these kind of edge case stuff, which most people are blissfully unaware of. So yeah, I mean, really what I'd suggest is for your listeners to get in touch with you with suggested topics, because there's a handful of things which are common issues, and have a vote on it. And if we do another one of these, we'll do it on what people want to hear about. So that's the best way. Know your audience.
To Marc's point, send suggestions to info@expattaxes.ie, info@expattaxes.ie, and we'll collate them, and we'll do it again soon. Thank you so much.
Great stuff. Thanks, Steph.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.